Warren Buffett has made $84.5 billion in his lifetime. But here's the part nobody talks about. $81.5 billion of that came after he turned 65. He did not have some secret strategy nobody else knew. He did not have insider information. He had one thing most people throw away every single day without realizing it. And by the end of this video, you will never look at money the same way again. Money. Some have it. Some do not. Some have mastered it. Most are still chasing it. You might think of money as numbers, spreadsheets, interest rates, equations that need to be solved. But the most important financial decisions in your life will never be made at a calculator. They will be made at a dinner table, surrounded by ego, pride, fear, and the weight of your personal history. The true nature of money is the tension between cold arithmetic and human nature. And when it comes to money, we are complicated, irrational, brilliant, terrified creatures. Financial success is not about how much you know. It is about how you behave. This video was inspired by Morgan Housel's extraordinary book, The Psychology of Money. Let us go into the strange, deeply human side of what money does to us and what we do to it. Chapter 1. Your financial DNA. Here is a question most people never ask themselves. Where did your beliefs about money actually come from? We all come from different generations, different parents, different incomes, different parts of the world, different economic environments. And those differences shape everything. Take the stock market. Someone born in 1970 watched the S&P 500 increase nearly tenfold during their teens and 20s. The market was a miracle machine to them. They grew up trusting it, investing in it, believing in it. Now, take someone born in 1950. They watched the stock market go absolutely nowhere during the exact same years of their life. Different conclusion. Less trust, more caution. Completely different financial instincts, built from completely different experiences. And inflation. Someone born in the 1960s lived through significant inflation during their formative years. They became permanently sensitized to rising prices, checking labels, tracking interest rates, wary of economic promises. Someone born in 1990 experienced relatively low inflation their entire life. They never felt it personally, so they never feared it personally. Same world, completely different financial psychology. Housel puts it perfectly, and I want you to really hear this. He says, people do some crazy things with money, but no one is crazy. Every financial decision you have ever made sense to you at the time, based on the information you had, the family you grew up in, and the world you experienced. None of us are crazy. We are all just running on different software. Chapter 2. The compounding secret that most people miss entirely. Let me ask you something. If you had to name the most powerful force in personal finance, what would you say? Most people say discipline, hard work, good investments. They are all wrong. The most powerful force in personal finance is time. And the proof is Warren Buffett. We said it in the hook. $81.5 billion of his $84.5 billion net worth was accumulated after he turned 65. That is not because he got better at investing in his old age. It is because he started at age 10. He had a net worth of $1 million by age 30. $1 million at 30 from investing as a child. And then time did the rest. Let me show you how extreme this is. If Buffett had behaved more like most young men in their 20s, spent some of his early income, started properly investing at 30, and retired at 60, even with his incredible average annual returns of 22%, his net worth today would be approximately $11.9 million. Not $84 billion. $11.9 million. That is 99.9% less. The difference is not skill. The difference is time. Now, consider Jim Simons, a hedge fund manager who has compounded money at 66% annually, almost 3 times Buffett's rate. By every measure of technical investment skill, Simons wins. Yet his net worth is $21 billion, 75% less than Buffett. Why? Because Simons did not find his stride until he was 50. He had less than half the runway. Time is the variable that almost no financial model fully captures. The counterintuitive genius of compounding is that it is almost invisible until suddenly. It is everything. Do not underestimate it. Do not waste it. Chapter 3. Luck, Risk, and Bill Gates. Chapter 3. Luck, Risk, and the story nobody tells about Bill Gates. In 1968, there were approximately 300 million high school-age people in the world. Of those 300 million, 300 students attended a small school in Seattle called Lakeside. And Lakeside happened to be the only high school in the world at that time with a professor far-sighted enough to lease a computer. Specifically, the Teletype Model 33, a machine so advanced that even graduate students at most universities did not have access to it. One of those 300 students was Bill Gates. From 300 million down to 300. The odds of being in that room were roughly 1 in a million. And Gates knows it. In 2005, he said, "If there had been no Lakeside, there would have been no Microsoft." Now here is the part of the story that almost never gets told. There was a third student in that group. His name was Ken Evans. Just as intelligent as Gates. Just as visionary. Just as likely, by all accounts, to have been a founder of Microsoft. Ken Evans never graduated high school. He died in a mountaineering accident. The odds of a high school student being killed in a mountaineering accident are approximately 1 in a million. The exact same odds that placed Gates in front of that computer. 1 in a million luck brought one boy a company worth trillions. 1 in a million risk took another boy's life entirely. Luck and risk are siblings. They move through the world together. And understanding that both are real, always real, is the foundation of financial humility. When things go well, ask yourself honestly how much of it was skill and how much was the wind being behind you. When things go badly, ask the same question. Chapter 4. The real key to happiness. Chapter 4. The thing money is actually for. People want to become wealthier to become happier. That is almost universally true. And for most people, the plan is earn more, buy more, do more, feel more. But the research tells a different story. Studies consistently show that the single most dependable predictor of positive well-being is not salary, is not house size, is not career prestige, is control over your time. The ability to do what you want, when you want, with who you want, for as long as you want. Housel puts it simply, that is the key to happiness. And here is the painful irony. The pursuit of more money, in the way most people pursue it, actually destroys the very thing money is supposed to buy. People work longer hours, answer more emails on weekends, take fewer vacations, delay the things they care about, all in the pursuit of an income that is supposed to give them freedom. But they never stop to buy it. Pursuing money without valuing time is like filling a bucket with a hole in the bottom. No matter how much you pour in, it keeps leaking out. The highest dividend money pays is not a stock return or a property gain. It is the ability to wake up on a Tuesday morning and decide what your day looks like. Chapter 5. Tail Events. Chapter 5. The hidden logic of tail events. In 1968, a man named Heinz Bergerwin fled Nazi Germany and eventually settled in America. Over the following decades, he became one of the most successful art dealers of all time, amassing a collection that included works by Picasso, Klee, and Matisse. In the year 2000, he sold part of his collection for over 100 million euros. What was his method? According to research firm Horizon, it was simple. He bought enormous quantities of art and held on to them for a very long time. He waited for a tiny fraction of those works to become masterpieces. He was probably wrong about most of what he bought. Perhaps 99% of the works he acquired were worth very little. He did not particularly care, because the 1%, the tail events, made up for everything else. This is called the long tail, when a small number of events account for the majority of all outcomes. This is not unique to art. Consider Amazon. In 2018, it drove 6% of the entire return of the S&P 500. One company. And inside Amazon, the growth was driven almost entirely by two products. Amazon Prime and Amazon Web Services. Two tail events that more than compensated for every failed experiment, including the infamous Fire Phone. After that failure, Jeff Bezos said, "If you think that is a big failure, we are working on much bigger failures right now. Some of them are going to make the Fire Phone look like a tiny little blip." He understood tail logic. Of the nearly 500 stocks Warren Buffett has ever invested in, only 10 have made the majority of his money. Good stock pickers are right roughly half the time. Good leaders make good decisions roughly half the time. The fact that you are wrong sometimes does not mean things will not work out. It means you understand how the game actually works. Chapter 6. True Wealth versus Being Rich. Chapter 6. The difference between being rich and being wealthy, and why almost everyone gets this backwards. It is easy to look at someone driving a Lamborghini or wearing a Rolex and assume wealthy. But here is what that assumption misses completely. Wealth is not what you see. Wealth is what you choose not to spend. Richness is about your current income and the visible things you own. Wealth is the financial assets you have yet to spend. The two are not the same, and in many cases, they're opposites. The person driving the Lamborghini may be servicing debt that would make your eyes water. The person driving a 10-year-old sedan and living quietly might have an investment account that has been compounding for 20 years. True wealth is invisible by definition, because the moment you spend it, it stops being wealth and becomes richness. Accumulating wealth requires something deeply unfashionable in the modern world. Restraint. The watches you did not buy, the upgrades you declined, the dinners you skipped. Every one of those is a brick in the wall of real financial security. We are conditioned to believe that having money means spending money. The influencer economy is built on that belief. But the only actual path to wealth is to consistently not spend the money you do have. The next time you see someone living in a big house or driving an expensive car, remember that you cannot judge wealth by appearances. You are only ever seeing the spending. The wealth, or its absence, is completely hidden. Chapter 7. The Real Price. Chapter 7. The price you have to pay and why most people try to steal it. Imagine you are climbing a mountain. You know from the start that there will be rain, wrong paths, difficult terrain, and moments where you consider turning back. But you also know something important. That uncertainty is not an obstacle. It is the price of the view from the top. You do not climb a mountain expecting a golden escalator. You accept the difficulty as part of the deal. Now consider investing. Housel uses a simple analogy, buying a car. You have three options. You could buy a new car at full price. You could buy a used car for less, or you can steal one. The new car is like aiming for strong market returns. High reward, but you pay the full price of uncertainty and volatility. The used car is a safer, lower return investment. Still legitimate, still worth it. Stealing the car. That is what most people try to do with the stock market. They try to get the rewards without paying the price. They jump in and out of positions, try to avoid dips. They buy at peaks and panic sell at troughs. They look for the trick that will give them market returns without market risk. There is no such trick. The price of strong investment returns is not measured only in dollars. It is measured in the ability to watch your portfolio drop 30% and do nothing. It is measured in the patience to stay in through a recession. It is measured in the tolerance for uncertainty most people find genuinely unbearable. The question is never whether you can afford the investment. The question is whether you can afford the price tag that comes with it. And that price is entirely emotional. Chapter 8. Enough. Chapter 8. The most important word in personal finance. Enough. There's a psychological phenomenon called the hedonic treadmill. Every time you reach a goal, a new salary, a new house, a new car, your baseline shifts upward. The thing that satisfied you last year is now just normal. And normal is never enough. So you run faster. You earn more. You spend more. You need more. The treadmill moves beneath you, but you never actually go anywhere. Look at the case of Bernie Madoff, a man who by any objective measure had already succeeded at a level most people cannot imagine. Already wealthy, already respected, already powerful, and yet not enough. He ran the largest financial fraud in history, not out of desperation, but out of an inability to define enough. The pursuit of wealth without a ceiling is not ambition. It is a trap. The most important financial question you will ever answer is not how do I make more. It is how much is enough for me, not for the person next to you, not for whoever you are trying to impress. For you, what does your actual life require to be genuinely lived well? That number is almost certainly smaller than the number you've been chasing. And the moment you find it and commit to it, everything changes. Conclusion. So those are 8 lessons from the psychology of money. Your financial DNA shapes your decisions more than you know. Compounding rewards time above everything else. Luck and risk are twins that travel together. True happiness comes from controlling your time, not accumulating things. Tail events drive most outcomes in business and investing. Wealth is what you do not spend. The price of good returns is emotional, not financial. And knowing when enough is enough might be the most important skill of all. Morgan Housel wrote a book that I believe belongs in every home. Not because it will teach you to pick better stocks, but because it will help you understand yourself. And in finance, as in most of life, self-knowledge is the edge that actually compounds. If one of these 8 lessons landed differently for you, leave a comment with its number. And subscribe, because every week on this channel we go deeper into the psychology that shapes the decisions you make every day, whether you are ready for that or not.